today that we are going to start with the current ratios, so which are also very important. If we want to know the health of the company, then ratio analysis is really one of the tools that can be used for making comparison from the one company to another company. Even also for one company, that if we want to know what is the current position, apart from looking at the balance sheet and all the figures, along with the profit and loss account of what is the profit and the loss, we can use this ratio analysis to know the real picture of the company. Just like that, we just want to know and diagnose the patient by the doctor, and just they have just thermometer, and just with the help of the thermometer and just with some the pulse check, then it can be recognized what kind of problem the patient is having. And the same case here, that if that we are going to know something about uh, the ratios, and then comparative analysis of the companies can be done very easily. Even the financial position of the concern can be done and judged with the help of a ratio analysis. So what ratio analysis is and how we can use that, this is the today's topic. So for the ratio analysis, the one ratio that we can say, this is the current ratio. So I'm just going to write here ratio. So current ratio is what? What is the formula for current ratio and how we can use this one? So current ratio formula is very simple. That is the current assets divided by current liabilities. Right? So this ratio shows that how much current assets that we have to meet our current liabilities. It means how much only current assets, mean liquid assets, that we have in our business to meet our short-term liabilities, short-term debts. So definitely our assets should be more and liability should be less. Our current assets should be more and liability should be less. For example, that we have here current assets, let's say 13,500, and we have current liabilities. Liabilities are 10,200, right? So what we can do, if we want to know the current ratio, and we know that the formula for the current ratio is current assets divided by current liabilities, then enter. So this is the 1.32 is the current ratio. It shows that we have more assets and we have less liabilities. Our debt is less. Or we can also interpret that we have $13,500, which is more than our liabilities. Even today, in case that we want to pay off all the debts, if we want to clear all the debts of the business, then our company is in a position to pay $10,200 right away. Maybe within a week or maybe within 1 month. After paying the current liabilities, even then the company will be having some cash in hand. So it means what is the standard? What is the standard for the current ratio? How much current ratio is good for the company? It is good if it is between 1.5 to 3.0. It is good if it is between 1.5 to 3.0. So now this is 1.32, which is also good, no problem. If in case, let's say, I'm going to change one figure here, the current assets figure. I'm going to change this to 11,000. By changing the current assets figure, the current ratio is also changed 1.07. I'm just going to make it for the 2 decimal points. So what I did, just right click on that, go to numbers and OK. So 1.08. This is also fine. But if in case I have written here 9600.94, which is not so good. which is not so good. It means like we have less current assets. If today we want to pay off all the debts of the company, right? Especially the current asset, not long-term debt. I'm talking about the only short-term obligations, only short-term obligation. And we are not so much confident in paying this one. If it is, let's say 10,200, it means whatever that we have, we are ready to pay and we can pay. Even then there is no any problem. One is also okay. But less than one, if we say like for 5,600, for example, it's a 0.55. It shows that our business is suffering with a shortage of fund. Our business is suffering with the shortage of liquid cash. I can give you, sorry, I can give you one example. Sometimes we go to doctor and doctor take a sample, like blood sample, and after then on the next day we see report, and according to the report we see that our creatinine level, our B12, iron level, then lipo profile, right? How much hemoglobin and diabetic level. There is the level set. There's a level set in the medical field. If my blood pressure is, I have, for example, between 80 to 120, it means this is normal. Diastolic and systolic. There are two kinds of blood pressures checkup. The one is for the upper one, and another one is for the down one. The down one should not be down than 100, and upper one should not be go up than 110. If this is the limit, for example, 80 to 110, this is the range. In the medical field, this range is set. And also for the creatinine, that is the body waste, like the waste in your urine, waste in your blood. If that is a 0.80 is fine. If the creatinine level increases, it means your kidneys are not functioning well. Doctor want to diagnose, doctor want to see that why the problem is there in your body. Why the problem is increasing day by day, there is something wrong. How this something wrong can be judged, can be diagnosed only and only with the help of blood test or maybe another tests. The internal position of a person, the health of the person can be recognized only with the help of these samples and these ranges, right? Same is the case with the organizations. There are a number of organizations that we work with, and we want to know how much is the current ratio. How much is the other ratios that we have. The first ratio is the current ratio that I have explained with this example. Now, if we talk about our example here, the profit and loss account we have already done, and we have all these assets that 75,705 is our current assets. On the other side, we have our short-term liabilities, means our current liabilities that we have 23,750. So in the ratios, I have calculated this one here, and I just want to go once again. What I'm going to do, put as equal to sign here. Then I'm just going to click on this figure 75,705. Then divide by, you can see this formula here, divide by short-term liabilities, mean current liabilities, right? Current mean less than 12 months. This loan is long-term, that I'm not going to add this one, but I'm going to add all these plus this one already that we have added this one. So this one divide by this one means current assets divided by current liabilities that we have here. When I press enter, I see that 3.19 is the current ratio. So what it means? It shows that company has enough resources to meet its short-term obligations. This is the interpretation of the current ratio. The second ratio we have debt to total assets ratio, or this also known as debt ratio. If we talk about the debt means the total debt. Total debt means the total liability. Total liability means short-term liabilities as well as long-term liabilities. I'm repeating again, short-term liabilities as well as long-term liabilities. In this example, we can see that the total liabilities we have here 23,750 as well as the long-term liabilities 25,000, but we will not consider owner's equity because this is owner's own money invested. This is not debt of the company. Right? So outsider liabilities are long-term plus short-term. So what I'm going to do, I'm going to add these two figures here. Even that what I can do, I can put this formula here for the debt ratio. So for the debt ratio formula, you can see it here, debt ratio. So debt ratio formula is here, total liability divided by total assets. So I'm going to write here total liabilities divided by total assets. So the total liability we have here is equal to sign. Then this is the long-term liability plus the short-term liability that we have here 23,750. This is 48,750. Divide by total assets. Total assets mean whether this is current assets, fixed assets, everything the total assets. There will be total of all the asset side. So here simply I'm going to write it here is equal to sign. And I'm just going to click on this 96,055 and pressing enter. You will see this one, the total liabilities and total assets that we have here. So if we see that according to this formula, the result that we want to see it here. So total debt ratio is equal to here total liabilities divided by total assets, when we can see 0.50. If I right click on this one, go to format number and OK, you will see 0.51. So I'm just going to make this borders and going to bold it 0.51. OK, so this is a debt ratio. Look at this, the range, the standard range is 0.3 to 0.6, 0.3 to 0.6. What this ratios says, it means if debt ratio is more than 1, it means company has more debt than assets. If debt ratio is more than 1, if debt ratio is more than 1, it simply shows that liabilities are more. Very simple, because current assets, current liability divided by total assets. 0.51 shows that we have less liabilities and more assets. So this is for the debt ratio. Now, if we talk about the third ratio, then third ratio is related to debt to equity ratio. Debt to equity ratio. So what debt to equity ratio says? So debt to equity ratio is used to evaluate a company's financial leverage. This debt to equity ratio is used to evaluate companies' financial leverage. It means total liabilities, whether this is for the short term or for the long term. The total liability divided by shareholder equity. Total liability divided by shareholders equity, or in our example, there is a owner's equity. More specifically, it reflects the ability of shareholders equity to cover all outstanding debts in the event of business shutdown or downturn. High ratio means high risk. For example, there are two persons. The one person is Mr. Mika, so Mika, right? Assets we have 120,000, liability we have 100,000, equity we have 20,000. So ratio will be 100,000 divided by 20,000 because we know the formula total liabilities divided by shareholder equities, right? And the example that we are taking of these two person want to take loan from bank, and bank want to see what is the position of your company. So how the bank will recognize? Like we should give loan to this person, Mr. Mika, or to Mr. Wang. It is just like the health report of an individual or a patient depicts that which medicine that should be given to that person to get it cured. It is just like that. So I'm a bank manager. For example, I want to assess that Mr. Mika is financially strong or Mr. Wong is financially strong. How this information can be collected and how I will evaluate. To evaluate the financial position, then ratio analysis are used, and the one ratio is a debt to equity ratio. For debt to equity ratio here in this case, we know that assets and liabilities and equity, three figures are given. Assets of the company is $120,000, liabilities are $100,000, and equity is 20,000. So in this case, $100,000 is the total liabilities divided by 20,000. Liabilities divided by 20,000. 20,000 is equity. 20,000 is equity. It means the 5 is the answer. Company has $5 of debt for one equity. It means company has $5 of debt, means $5 of debt is there against $1 of equity. It means high leverage, high borrowing. So application, I will not accept, it will be rejected. I will not grant loan to Mr. Mika. Next, when I look at Mr. Wong, when I look at Mr. Wong's financial position, then what I see that Mr. Wong assets are $150,000, liabilities are $50,000, equity is $100,000. Equity means the money is invested by the owner. In case of Mika, only $20,000 was invested by the owner, you can see. But in case of Mr. Wang, $100,000 is the equity, and the ratio is total liability 50,000 and equity is 100,000. It means only 0.5 company has debt, means 50 cent, means 0.5 of the debt for one equity, which is very low in the risk, and definitely I will approve this application. So leverage, what is leverage? Leverage is the use of debt. Leverage is use of debt, means use of borrowing in order to undertake an investment. This is the leverage. So it means if this is high leverage, means high ratio mean high leverage, low ratio is low leverage, high ratio is risky, low ratio is not risky. This is safe. It is just like the assets that you have, the liability you have, the equity, the three figures we have. And the liabilities are more as that how much money we have. That's simple thing. Same example that we are going to do for the debt to equity ratio here. So I'm going to write it here, debt to equity. So debt to equity, debt mean a liability, very simple. Debt mean liability. So what I'm going to write here, liabilities, total liabilities, then equity, right? So total liability, how much is the total liability? We know this one and this one is the total liability. So what I'm going to do is equal to sign this one long-term liability plus short-term liability as we did in the previous ratio. But debt to equity means equity. Equity is here how much? 47,305. So is equal to sign 47,305 and enter. Now debt to equity ratio. Debt to equity ratio formula is total asset divided by equity. You can see it here. This is the formula. Total liabilities divided by shareholder equity or total equity. Now look at this. Is equal to sign total liability divided by equity means 1.03. So we have 1.03 of debt to equity ratio. Now, if we talk about which is the standard range, what is the standard range? The standard is the between 1 to 1.5. 1 to 1.5. It means the project that we are working is very safe, right? And it is between 1.03 to 1.50. So this was all about the ratio analysis that we have completed here.